Okay, so what we were talking about is for the return to provision, I would stick last year's provision, the current calc, next to the equivalent from the return, and out would pop a difference. And I'm going to book entries to reflect those differences. And when I book those entries, I'm going to fix my account balances. And I know I'm right because I'm going to fix my accounts line by line. And then I'm done when I can explain my trued up year one balance. Okay, pausing for effect. That's super important, right? Take your time, fix the balances, do this account reconciliation, improve your balance. That is so important.
So the column is the name total, actually is a checking the column, make sure.
Total, the column on the far right is just to show that everything I did balances. I once did a provision for, I think my favorite provision project I ever worked on was, really by far, a client, it was a multi-billion-dollar company. They were outsourcing their provision to a big four that was not me. And they hired me because they were worried about that big four that was doing their provision. They hired me to spy on the other big four. I'm not kidding. And I sat in the building behind the building that the other firm was in doing the provision. I was in the next building.
So how did you spy?
So every time, so this company had two tax people. The top guy was an attorney, and this stuff to him, like if you think you're having a hard time, he's like, not listening anymore. So he had no idea, and the other guy was just, it was over his head, it's too much. And so they were worried, and they're like, we think we're really heading down a bad path, so we just want somebody to tell us it's okay. And it was worth it to them for me to sit in that other building, and every time they got sent a schedule, they just forwarded it to me. And then I would type up questions as if I was them, and I'd be like, send this email back. And, Kunal, you probably know this story. You probably know who it is. And so I would type it up, and I'd be like, so tell me more about this, because I don't understand how it works with this. And it's very easy to identify problems. It's a lot harder to fix the problems. But I could, right? So I could be like, this does not look right. Are you sure? Right? And so then they would respond, and those guys would email me the responses, and I'd be like, okay, well. And I did that for a week and a half. And yeah, it was wild. And one of the things that they did, which was just unbelievable, was in this total column, they had a spreadsheet that was the equivalent of this, and they had an entry that looked like this. And it didn't work. And so what did they do? They deleted that. I know. And I'm all, really? How's that working? And they're adjusting entry, like what Grant was getting at, in terms of whether they wanted to book to adjust their provision accounts. It didn't balance. It wouldn't balance.
No, because it's still high.
Right, they booked a one-sided entry, right? And they plugged it to OCI, which is this account no one understands, and so it must be right. Right? It was awesome, right? And I remember writing the comment, I was like, this entry doesn't balance, right? And yeah, you looked at this schedule, and there was this account roll forward probably 100 lines long, and one row in the proof was missing. And I'm like, it took me a couple days to find that. But just because the volume of numbers,
And you made the lawyer look like a genius.
Exactly. Lawyer's like, I'm picking it up now, right? He did pretty well. So anyways, you might, Lena's question's a good one, but you might think that that's silly because it looks so obvious here, but it's not silly. That's critical, right? If you can do a schedule like this that balances from top to bottom, your provision will work. Okay. So you can spend time with the spreadsheet at home, but I can't emphasize enough that I want you to think about the year one fix separate from the year two provision. Okay? All right, so the rest of this provision file, I kid you not, is just the facts for year 2 in the same tabs as the year 1 provision, right? I input the payable, right? I only had $1 million of income in year 2. I had meals and entertainment. I didn't even have fines and penalties. But it's the same stuff, right? It's year 2 just like year 1. There's nothing special about it. The hard thing about year 2 is to fix year 1. It's not doing year 2. It's the same thing. Okay? So I'm not going to go through it again because if you followed year 1, it's the same thing. So I got everything balancing. My facts are all different, but it's the same stuff. It's just a different year. I use my new state rates. I got credits for state, but I don't have credits for federal. And I got my new, year 2 entry. It foots to 0. It's the same thing, right? Now I'm like in the mode of being able to kind of figure this stuff out quickly.
So, excuse me, that doesn't mean in our homework, last time homework, problem 3, exactly the same, but our rate exchange, we need to fix it year 1 and then go to year 2.
Sure, I don't remember your homework 3, but if we have time, we can go through it. Caitlin's like, you better. Okay. So anyways, so the year 2 provision, the payable tab, it's just taking the facts off the problem, sticking it in just like we did year 1. It's just the next year with the number in the end of the date mark, changed by 1. That's it. New facts. Okay. So my deferred schedule, it now takes beginning, it takes my true up, which I already booked, and then it takes my current year activity, which I'll book as part of year 2. Okay? So I'm just rolling forward my deferred. I take the beginning balance, I fix it, and then I book that as part of my true up, and then I adjust it again for my year 2 activity, and I book that as part of my year 2 provision. So think of these columns as each creating their own journal entry. In fact, what we did with Rochelle and Janie's boss one year, I remember we had so many things that were changing the deferreds. Our deferred roll forward spreadsheet had bazillion columns. I don't know if your guys still has it, if that's the way she thinks, but we would just separate every little thought we had into its own column and be like, that's a journal entry, okay, that's a journal entry, and we would just make it balance. So sometimes you won't see deferred schedules so concise like this. In fact, you'll see I acquired a company, how does that affect my deferreds? My tax rate changed, how does that affect my deferreds? I sold a business, I had a valuation allowance. You can put all these things in separate columns just to kind of get your thoughts wrapped around it so you don't have too many things happening in one column. And every column represents a journal entry, right? So everything you look at columnar should be debit, credit. What's my debit? What's my credit? So when I get to my accounts page, my year 2 provision, it's basic, right? It's super easy. I just pull right off my payable tab my balance journal entry that I just naturally got to by having every piece of the provision balance. So that in and of itself is not hard. Okay, so here's where you'll get to this part of the spreadsheet and you'll get mad because something doesn't link right or something like that. You're like, I got the rest right. How come your spreadsheet isn't any good? And again, my response will always be like, I don't care. You figure it out. And now, when a company is showing what their current provision is and their deferred provision, you can see it's not only the current provision they owe this year, but it's the fix of the current provision from last year. And your deferred provision is not only the change, but it's the change including the true-up. Everything's in there. So this is your current plus true-up current, deferred plus true-up deferred. So there's 2 things in each of those numbers now instead of 1. Okay? And then out pops your total. So if you thought of those journal entries, right, everything that's hitting current expense is going up in my current expense disclosure. Everything that hits deferred provision hits my deferred, right? And then my total pops out. So when you go to your rate rec, And I know it looks easy when it's just done like this, but your rate rec looks pretty straightforward, right? You have your meals and entertainment, your book income. So now there's a couple things that are going on that are a little harder to figure out. Oops, no, I don't want to do that. So the first thing that's hard is I have a meals and entertainment true up of $5,000. So my provision expense permanently went down because last year I overestimated my meals and entertainment add back, and this year when I realized it's not as big, I have a permanent good guy. Right? I book in year 2, right? You asked when do I book this? I book it in year 2, and now I've got to explain why my year 2 provision is lower. Well, it's lower because I found a year 1 goof. So I'm going to show you in my rate rack, hey, I found this good guy. So that $1,750, that's me saying, hey, good news. Found a tax saving thing that's a permanent in nature item.
This could go on and on, right? I mean, it grows. 6 years ago, a tax return or something like that.
Absolutely. Yeah, so the reason I couldn't balance this rate rec when I was doing the solution is I missed the fact that there was a true up in the credit. And I was like, it's off by $1,500. And it took me like 5 minutes to go back and figure out what I missed. And when I looked at my return to provision, the difference between the credit was $1,500. And so my tax permanently increased compared to year 1 because my credit was smaller than I thought it was going to be. So my rate reconciliation has to tell the reader, hey, guess what? I have more expense because my credit is not as big as I was hoping it was going to be. When I told you my provision was X in year 1. It wasn't X, it was bigger. Okay, does that make sense? So all I'm doing is I'm taking perm items, which we know go in the rate rec, and I'm putting last year's fixes to perm items in my year 2 rate rec. I'm saying not only do I have to explain this year's perm items, but I have to explain how I fixed last year's perm items. All that perm stuff goes in your provision. And now the real zinger is the state provision. Oh, whoops, I want to do that. So the state provision, inside that 85, so this is kind of funky, right? I have $1 million of income, and I would expect a positive expense. But in fact, I have a benefit, right? My state provision is negative, which is awesome state planning, right? My planning is so good, they pay me. And the reason is that your true-up was so large because of that rate change. Remember, we thought originally in year 1 my state rate was going to be 8.5. But it turned out to only be a little over 7. And that difference on $10 million of year 1 income, that's a big difference. Especially when compared to I only had $1 million of income in year 2. So that true up from year 1, it looks huge. It looks like I saved all this money from year 1. And because the year 2 is small, that year 1 catch up or that fix, it looks just really large. And so I have a net benefit in there. And it's really hard to pull that apart and see that that's part of that 85, but that's what's driving that. If you pulled that state provision apart into pieces, the best way to look at it is to look at this column in your spreadsheet. Your true-up was $122,000. You had a true-up benefit for states of $122,000, mostly because you completely overgassed your state rate, right? And that $122,000 is huge compared to your year 2 expense. And so it looks like you have a net benefit, but it's just the combination of two things that are really unrelated. And that 85, that's your total state provision. That's what will flow into your rate rec. Okay? All right, boom. You get that? You get an A. No problem.
Have fun praying for a C.
Yeah.
Why have high hopes?
That's it. Okay, so I'll send you the spreadsheet. Play around with the spreadsheet. We can talk about it more next class. But I would encourage you not to get too wed to it. I mean, don't use it as like too much of a handicap, right? Think, right? Think debit, credit. Think concept. That is way more important than like getting the formulas right and the linking and all that kind of garbage, right? Think. All right. All right, so now we've done a big provision. And the final step of our 10 steps is to do the disclosures. Okay? So there's really two main pieces to your disclosure. I mean, if you pull up a 10K, you'll see towards the front there'll be a section called MD&A, which is Management Discussion and Analysis. That's where management is telling the reader what happened. Our taxes were higher than last year. They were higher because of X. Our taxes are going to be lower next year because of some other thing. I mean, it's them telling you what's happening and why, right? They're like reporting the news. The tax footnote, which is the second part of this slide, that's the company giving you, some more precise details on exactly what happened and them complying with the requirements of ASC 740 in terms of what they have to tell you. Okay? So if you did the reading, you'll see that there's quite a few things that you're just required to say. Okay? In fact, I did a training up at a client of mine, a big company, and they just wanted to get their tax department in a room, or all their directors and VPs in a room, and just hear why we had to say things that we said. And because I think, like, if you're, the VP of international tax at a large company, you have no idea what the provision person's doing or why you say what you say in your footnote. I mean, that's not your world, right? You're the international person. But if you see a disclosure and you're like, hey, I would have rather us not said that. That doesn't help me from like my German audit perspective. Then the international VP would be like, can you tell me why we said what we said? Because I don't want to say that kind of thing anymore. So I put on a training for them where I said, these are the required disclosures. This is why we say what we say. This is optional. This is required. And this is a good thing for people to be educated on, because I think when I was younger, like when I was most of your ages, I was thinking that disclosure was just whatever we said last year. We say it again, and we just change the numbers. But these days, people put, like Tracy Hahn puts a lot of time into what's said in her disclosure. And I guarantee you, in 2 weeks when you meet Elaine, she will say, I spend a lot of time writing that disclosure, and I'm very careful with pretty much every word. Yeah, I mean, that's very consistent of companies. So know that what goes into these two sections is very thoughtful. Okay, so when you read ASC 740, you'll see that there is very specific guidance in terms of things that you need to describe. And so let me just kind of go through a few of them. So you have to classify your deferreds as current or non-current, right? And so on the face of the balance sheet, you got to put it in either the short-term or long-term section. And I told you how to do that. It's through looking at the underlying item that's causing the temp. And if it's current or non-current, your deferred becomes current or non-current. Okay? So this is a goofy rule, but you actually have to allocate your valuation allowance between current and non-current. And you do it on this kind of strange, ratable basis. So even if you said, oh, my NOL is all non-current because I'm not going to use it for a long time, you don't put your valuation allowance all with non-current. You do this allocation thing, and it's just required. It's just mechanical, straight within ASC 740. If you have a valuation allowance and you want to know more, read the rule. It's pretty straightforward, but it's kind of strange, and it's just required. So this catches a lot of ignorant companies, that are just not savvy to this by surprise. So you've got to present, what your different tax-paying entities are, right? You got to map out for people, if you're in multiple jurisdictions, and kind of tell the story. Jimmy, is there such a thing as a reporting unit? There is, but not for tax accounting. Yeah, that's a FAS 141 concept, or a FAS 142 concept. Okay, other things you got to say. When you read these companies' financial statements, you probably always see a little paragraph where they tell you about their NOLs and credits, right? They have to tell you that. If they talk about their valuation allowance, it's because they have to. If they break out their provision between like continuing ops and disc ops, like I'm running a business but I'm also selling one, they do that because they have to. Okay, so all this stuff is just like specifically right in the rules. I have to break these things out because they tell me to do it. I got to do a rate rec. When you read the rule on rate recs, it says you got to reconcile your expense. You can do it in numbers or percentages, right? It'll tell you exactly. You can pick. So of the companies you review, you'll see some are percentages, some are numbers. One disclosure that we'll talk about in the last class is that undistributed earnings disclosure. I spent a couple hours with a company today that was fretting about this one. And you have to say that if you're not going to repatriate your foreign earnings and pay U.S. tax on it, you have to basically tell the reader in the financials how much those earnings are and how much tax you haven't accrued. Right? So if you have $100 offshore and it would cause you $35 of tax to pay a dividend, you're supposed to say, hey reader, I've got $100 offshore and I'm not accruing a $35 liability because I'm going to leave that 100 there forever. That disclosure gets a ton of attention. A ton. What a lot of people say, which is canned language right out of ASC 740, is I've got 100 offshore and it's not practicable for me to tell you how much tax I would pay to repatriate that. It's like the one and only time in your life you'll hear the word practicable. But that word is right in ASC 740 and everyone uses it because they repeat the rule, they repeat the language right out of the guidance into their disclosure, and it's very common. And it's funny because a lot of people kind of know what that tax is, but they don't want to say it. The SEC is all over that issue. They're like, so it's not practicable? How come it's not practicable? You know, what do you got to do to make it practicable? And you know, Google kind of became famous for this because they were the first company that I saw that got a comment letter from the SEC, and it said something like, you say that it's not practicable to determine what the tax is to repatriate your foreign earnings. And they're like, yeah, that's right. And so then the SEC said, well, you know, why is it not practicable? And their answer was, we don't plan on repatriating our foreign earnings. Because all these comment letters are public, by the way. Like, you can go find it yourself after class. And they said, well, we don't plan on repatriating, so why would we even calculate it? And they're like, right, but you could calculate it. And they're like, yeah, but we don't plan on repatriating. And so companies have kind of drawn a hard line with the SEC on this. Like, they don't want to do a bunch of hypothetical calculations because what they're trying to say is, I'm not repatriating, so why would I tell you a number? That number is not helpful, right? I'm not repatriating. But that is a super big issue. There was a bunch of Senate testimony on this topic with Senator Levin, who made a couple big Valley companies testify recently, and it was about that rule. And they wanted to know why companies are saying certain things in their financial statements and why they're not paying more U.S. tax, and it's all focused on that accounting rule. That area is super sensitive. Other rules. So, you know, I've said this before in class when we covered UTBs. There is a whole bunch of required disclosures now that you got to put in your financial statements related to your reserves, right? So you're supposed to basically put a table in that says how much your UTBs are. You have to disclose your interest, a penalty. So one of my clients is going to accrue like a $30 million penalty this quarter, $30 million bucks. And they're going to have to put it in their financial statements. So we'll see if you can figure it out, because you might run across them. And then we can talk about it. You're supposed to put a statement in there that says, in the next 12 months, you know, I think something's going to happen to my reserves. And you're supposed to give an early warning, right? Like, my statutes are all going to lapse and I'm going to win. It's going to be awesome. Or, I think they're going to get me. This is not good. Run. right? I mean, you're supposed to, obviously that's a joke, but you're supposed to say something that will inform the reader, like, hey, something good might happen or something bad might happen, or let me inform you as a potential investor of what you're getting in for here, because taxes are very gray and stuff can, good news and bad news can surface. So you're supposed to give early warning to the extent you can, which companies hate doing, right? Because you're almost always wrong. You are supposed to describe what years are open for audits in your major jurisdictions. So this is a lot of information, right? So when you read companies' 10Ks, I mean, I'm sure when you read into it, you saw all these things, because they have a checklist. They'll go through it and they'll be like, did I say that? Boom, yes. Did I say that? Yes. Right? That is standard procedure. Interim stuff, that's quarterly. We talk about that another time. Okay, well, we already hit part 2. We kind of just nailed all that together. I could have joked and told you there's another part of that Excel thing we should do again. Okay, so we're done. We did the 10 steps of provision. Okay, and now the question is whether you can do the 10 steps of the provision. I feel like I can do it. Can you do it? You will get lots of practice. For the next class, do the reading. Of all the classes you should do the reading in, this next one is the best one, the most important one. Next class is stock compensation. I think I told you in the first class that this is the one that people are the most frustrated by, because it's such a weird topic. It's so strange. And, I mean, you guys can probably agree, right? I'll teach this topic 2 nights in a row. Class 5 and Class 6 will cover the same thing, because every year I've taught, at the end of Class 5, people are like, I hate this class, I'm going to get out of here. And then in Class 6, people are like, it makes more sense to me now. But if we don't cover it again, it feels like people don't pick it up. I think you guys would agree. You're smiling, so that's basically how it is. And then on Class 6, when we go over it again, that's the class that Elaine will come from LinkedIn. And she has a lot of stock compensation issues, so she can tell you her war stories. And I'm actually going to have a guy come and guest teach part of it too, who he's potentially more articulate than me, so maybe if I do a bad job on Class 5, he can improve and patch it up in Class 6. Okay, so do the reading. So this reading right here, this will take you 3-4 hours to do. Okay? It's not a lot in terms of pages, but you're crazy if you don't read it twice. Okay? Okay, so do the reading. Read. Some of this stuff, this and that, it will duplicate. It'll overlap. Okay? I don't care. I did it on purpose. Okay? I don't do a lot of things on accident. So read it twice, read it slowly. Ask yourself, what does it mean? When you're reading it, try to come up with journal entries. Like, if I had that, what would the journal entry be? How would this affect my rate? Like, think. I mean, don't just like read to get to the end. I don't care if you get to the end. I won't care if you understand it. Okay? So do the reading. And then pick up the Amazon 10K and pick it up thinking stock comp in mind. Okay? I don't care if you understand their whole footnote this time. It'd be great if you did, but pick it up thinking, well, what do they have that's related to stock compensation? What do they tell you about the tax consequences of stock equity compensation? They have some pretty cool stuff. And you can't just word search stock comp and it will come up either. I mean, you need to read the tax disclosures and look for areas where they talk about stock comp. This will not be easy, but read thinking like, where does stock comp fit into all their disclosures? How is it changing the answers? And so take the 10K printed out, circle the sections that have anything to do with tax on them, and turn that in. Okay, so I want to prove that you looked and found something. You guys are like rumbling. What was the questions? Lena?
Can you repeat that again?
Can you do what?
Can you repeat the requirement again?
I want you to take the Amazon 10K, print out pages that are relevant to tax, circle sections that have anything to do with the tax effects of stock comp in any indirect or direct sort of way, turn it in. Just prove to me you found something related to tax and stock compensation. That is what I want you to do. Okay? Okay, and then your last assignment. This is probably cracking Anna up right now because I was told that my class didn't have enough homework, so you guys get the pain of having more homework. And this is exactly... I know. What? Can you believe it?
Idiot.
I won't tell him you said that. Okay, so your third homework assignment is write something short, 1 page, of 3 stock compensation related items that impact your ETR and why they impact your ETR. Okay? So you know what the ETR is and you know what changes it. Now when you do the reading, you will learn what items in there affect your ETR. You cannot do this without doing the reading. Okay? Write 3 paragraphs, 1 paragraph for each item. So for example, you will say, this type of stock compensation will affect my ETR because, say something logical. Right? Next paragraph. This type of stock compensation affects my ETR, here is why. Right? There are more than 3 right answers. So you just need to find 3. Okay? This goes on 1 piece of paper, and I want you to write it down in a way that if I was, your boss and I wasn't a tax person, I knew what in the world you were talking about. Okay? Write it so somebody can understand it. Like, teach me how it affects the effective tax rate. When FAS 123R first came out and stock compensation was new, it played havoc with a ton of companies' effective tax rates. So I was constantly meeting with like CFO types to say, this is why, right? And they don't want to see like an 80-page slide deck with a bunch of rules, right? They want to hear it in like an elevator speech. They're like, I want to hear you for 15 seconds, and after that, I don't want to hear you, right? So think of it that way, right? All right? I mean, it is a challenge for you to, A, write something because you're an accountant, and B, write it in a way. Trust me, that guy from Amazon would definitely say that. Write it so that, it sounds like you could just email that over to the LinkedIn CFO and be like, hey, your tax rate's high, here's why. Right? Remember how we were joking around with Wenju about how she eats too much and how like that affects her effective tax rate? Think of it that way, right? Hey, you got too much of this stock comp. Your rate went up. You should do less of that. Right? Okay, that's it.
I was splashing in the water.